Hey guys, I'm John Fryer. Welcome to Fryer Funds, welcome to my kitchen, and welcome to the Fryer Feast series. In this series, we took $15,000, we're investing it into individual companies, with all investment decisions made over the weekend to be executed on Monday. This is for people who work 9 to 5, who don't have time to trade during the week or make decisions during the week, so we focus on the weekend execution and go from there. Now, I want to point out, this is not financial advice, this is not legal advice. Consult your own advisors and make your own decisions. But with that said, let's dive in, see what happened this week, and where we're going from here. Alright guys, so let's get into this. It has been a while since I've recorded, but here we are. So, we're currently sitting at $17,350, up from the $15,000 we started with, which is better than the S&P 500 since we've started, although over the last 2 weeks we haven't done as well because COVID cases have started to spike, the stock market's starting to reflect that, and just in the nick of time, I ended up buying quite a bit of the recovery stocks because I didn't think we'd have another outburst like we're having. So we are down from our peak, which was about 19,000 right here, the beginning of June. So we're not at the peak, but we're still definitely up and better than the S&P 500 since we started. But with that said, this week or this Monday, I've got quite a few things I'm going to be trading. But these first two I wanted to talk about because I'm actually kind of excited and I wanted to show you how I found these, why I'm buying them, and give you a better insight into my thought process here. So the first one is Skechers. Now, what brought me to Skechers was this. There is this article on CNBC about Apple Maps usage and what it's being used for. So you can see the drop off after COVID where no one was kind of moving around. Since then it's recovered quite a bit. Transit not so much, it's still down 50% from where it was the beginning of the year. Driving is actually higher than what it was. And then walking is still kind of recovering but is definitely up there and higher than what it was the beginning of the year, but not necessarily before COVID. But okay, so with that. Now, driving, I don't believe people are actually driving more than they were pre-COVID, but I do believe people are driving to new places. So they're not driving to work, obviously. They're not going to places they know, so they're going to new places. They need more Google Maps, or Apple Maps in this case, since that's what this chart is. So people are driving to new locations, but they're not necessarily driving more. So with that, I didn't want to do anything. Walking, on the other hand, now, I thought, well, people are going to walk more than use mass transit. And yes, they're going to drive more than mass transit as well, but not enough to cover not driving back and forth to work. But people are walking quite a bit, not quite as much as before with maps, but again, they're walking to probably familiar places that they were using transit for and stuff. So I started to think, okay, well, if people are walking, what are they going to be buying or spending money on? Well, shoes. So I started to look at Google Trends for shoes. Now I tried basketball shoes, tennis shoes, dress shoes, things like that. All of those were down, but then I found running shoes are actually up quite a bit in searches. Over the last year from a year ago, search volume was 65% of the max, which the max was beginning or middle of May, I should say. And it's actually stayed up here above the 75% line of what the max was, where before 75% was kind of the peak. And if you look over the last 5 years, it's kind of stayed in that 75 to 50 range, a couple of dips down, one little dip up here. But this massive spike in running shoe searches really kind of tells me people are replacing their shoes. They want to get exercise, they're walking around, people are buying running shoes. All right, so how to invest in that? Started looking around at companies. Now, I settled on Skechers in this case. I did look at Nike and a few others, but Skechers, this is why I like them. So over the last 5 years, they've slowly been growing, but then there's a huge spike over the last few months after the COVID dip as people are looking for running shoes. And if you just compare it from a year ago, it's kind of got the same pattern as the running shoes chart. Now, if you go to Skechers.com, check this out. The actual website search has drastically, like that, it's been sitting about 25% of the peak, which its peak is right here. So it's gone up 2 to 3 times, and actually 4 times at the peak of what the volume was before. And over the last 5 years, like that, it just blows it out of the charts. It's been sitting around 25 to 50% on the peaks, and so it's doubled. Their online shopping to their website has doubled, or at least their search volume. So that's a huge spike. Now Nike, of course, they had a spike too, so did the others, but it doesn't look like this. If we just go to Nike.com, just a quick search, yes, actually it's down. Nike's been trending down over the past 5 years. It is up, but it's not up significantly. So if you look at the stock of Skechers though, from a year ago, it's sitting still below where it was a year ago. Now I don't expect they'll actually make as much money as they did last year necessarily, but there's definitely a lot more upside here. If you go over the 5-year trend, its peak was 60, and people are buying running shoes and going to Skechers a lot more than they ever have. I think Skechers has a lot of upside potential, possibly even to set a new record over the next 6 months. So they could hit maybe 60, which is double from where it's at. If not, it's got to at least reach peak, or what the peak was pre-COVID, which was 44. I don't know if you can see these numbers on the YouTube video if you're on your phone or something. So I'll just tell you that Skechers is currently sitting at about $30 a share. Its peak pre-COVID was $44. Its peak up here 5 years ago was $52. So if it gets up to 45, that's a 50% increase. If it gets up to 60, that's doubling the price of the stock right now. So I really like Skechers with where they're at. People are buying running shoes. Skechers has a lot of growth, which is what investors tend to like, is growth of a company. So I really think Skechers has a lot of upside and is going to be a good buy. So we're going to open a position in Skechers. Now the other company is Netgear. People are working from home. They had to upgrade their internet connection, but they've also had to upgrade their internal networks. And Netgear, looking at its search volume on Google Trends, has also gone up significantly since the COVID sell-off. And then if you go to the past 5 years, it's not necessarily setting new records. It had a huge record back 5 years ago. I think there was some special events going on, if I remember correctly. My background's in tech, so I remember some news a few years ago about Netgear, so that's probably what that was. But it's sitting at its kind of highs right now. Netgear Nighthawk, which is one of the best-selling routers out there, sits at Costco. It's up there on Amazon. It's been growing over the last few years, and it has really spiked with COVID and people upgrading their home network. And even just the word router, people are really searching for. Not necessarily as high as some of these past events, but definitely a huge peak. Now, if we look at the Netgear stock over the last year, it's again sitting below where it was a year ago. Now that seems really weird to me because I believe Netgear is making a lot better sales than they were a year ago. So I think this has huge upside potential. Pre-COVID, its peak was around 26, so only a little bit up from where it was, but its peak back in last September was at 37. So about 50%, or 36, about 50% where it sits now, which is about 24. If you go over the last 5 years, it did have a huge spike back in mid-2018 before kind of the tech sell-off happened and got up to 76. Could it hit that again? I don't know, because I don't know how long this home network upgrade phase is going to last. But more people are going to be working from home. They're watching a lot more Netflix. They need a better network. So I do think there's a lot of upside. It could double to 50, possibly get up to this range. And it could triple up to get to 75. That seems like a stretch, at least in the next 6 months. It could down the road, but over the next 6 months, I don't think so. But I still think this could very easily have a 50% to 100% upside over the next 6 months. So Netgear and Skechers are my two new favorite positions to open. I've got two others here, Grubhub, because people are sitting at home and getting food delivered. And then here, which is Turtle Beach. They do particularly, or specifically headphones, gaming headphones. Their stock is up quite a bit. They're doing really good. I still think there's a decent amount of upside, so we're going to open a position in Turtle Beach here. But Skechers and Netgear, those are my two new positions that I'm really excited about. Otherwise, everything else here, we're going to kind of lower our cost basis on Etsy and American Airlines, a couple of restaurants, a little bit of retail. MFA, which does residential real estate refinancing, that's really high right now with the mortgage rates being really low. And then SABR, I still really like them. They provide the software for like airlines and hotels and other travel companies. They're like the core backend software. So as those recover, SABR should do really well, especially as more of those companies invest in saving money using software. So I think SABR will do really well. But the rest of these, they're just kind of lowering our cost basis. And then down here, we're going to sell some. So UPS, FedEx announced their earnings. They did really well. Both FedEx and UPS spiked. So we're going to sell one of our 3 shares of UPS to capture some of that profit and then hold on to the other 2 for now until after UPS reports their earnings, and then we'll see where that goes. Activision and ZNGA, both those are games. Games have run up quite a bit, a little bit more than I think they should, so we're going to lower our positions there. Then LivePerson, a really good company, or at least a really good stock that we've done really well on. I want to lower our position there. Currently, it's sitting about 2% of our overall portfolio. We're going to dump it down to 1%, so selling 4 shares, leaving us 4 shares. We're already upside 100%, so we're basically getting our initial investment back and having and left over 4 more shares of LivePerson for the extra growth. These last 2 though, so Comcast, we're going to sell the 4 shares that we own, exiting the position. Comcast, yes, it's an internet provider. There is some upside with their theme parks and TV and stuff, but something's odd about what's going on with Comcast stock. I don't know if investors don't like it, if there's something wrong with the fundamentals, but something tells me Comcast doesn't really have a lot of upside, maybe 10%. It's not worth holding on to because there's a lot of potential downside risk. So we're going to exit out of Comcast. And then Micron. Now this is a good company. They did report saying that data centers demand has been up significantly, but the stock again didn't jump very high. So it's kind of already valued about where it needs to be. So there's not a lot of upside in Micron. Yes, it's a good company, could be good for a long-term hold, but there are other companies I prefer. So we're going to exit out of Micron at this point as well, take our profits in both of these and exit out of those positions. So that's where we're at. Again, Skechers and Netgear, those are my 2 new positions that I'm really excited for here down the road because they're kind of lagging behind what the economy and what the company should be doing. So those I'm really excited about. But that's kind of everything that I've got going on with this portfolio right now. There's a couple others I'm watching that I wanted to open positions on, but it doesn't feel like the right time just yet, so we're going to wait another week. So yes. Now, I also want to mention the M1 Finance Friar Pie series. I haven't recorded on that either, so I'm just going to give an update here. I've been putting $100 a week into it. I did miss 1 week, but overall I've put $1,000 into it. That $1,000 is currently worth $1,030, so it's gone up just a little bit, but those portfolios have kind of been flat. Now that's the Friar Pie, the all-weather portfolio, the Golden Butterfly, and just the S&P 500. So dollar cost averaging in all of those, they're barely up, but that's not too bad considering it's just a easy portfolio. You don't have to manage it, you don't have to trade, you just put a little bit in every week and it just grows a little bit at a time. So that's where we're at. Thanks for watching, and again, this is not financial advice, this is not legal advice. Consult your own advisors and make your own decisions. But with that said, we'll see you next time.